Let's shift focus. Let's talk about Canfin Homes. What is really their margin and outlook on loan growth going forward, and what really is the way forward for HFCs or housing finance companies? Let's take stock of all of that. We have with us Girish Kousgi, the MD and CEO at Canfin Homes, joining in on the show right now. Girish, hi, good morning. Good to have you on the show. Girish, from an industry perspective, NBFCs are clearly back on their growth path. Reports are suggesting that HFCs are looking to drive for growth on the back of rising demand. Help us understand what the current market dynamics are and what are the data points on ground really indicating.
Good morning. So if you look at the industry, it started picking up after COVID first wave from Q3 of last year. So Q3, I think there was some revival in terms of demand, and Q4 was exceedingly well for almost all the companies. I'm talking about the industry. And again, Q1 of this year, because of COVID second wave, there was some impact. That's because, I think as an industry, we lost about 40 odd days due to COVID-2. And Q3, we bounced back. And Q3 and Q4 is going to be far, far better for most of the companies in the industry. So if you look at demand in last 4 quarters, barring the COVID quarter, rest all quarters are very good. If you talk about Canfin, Q4 of last year, we did all-time high disbursement numbers. And if you look at Q2, we did 10% more than Q4 of last year, which was again all-time high. And I had mentioned earlier, I can't share specific numbers I had shared earlier. Q3 and Q4 of this year for Canfin is going to be far, far better than Q2. And Q2 was the best ever number. And if you look at the market, real estate as a space started reviving. We see development happening across, whether it is developer market or non-developer market. Within developer market, I think barring the premium segment, where it is slightly low, rest all segments have done very well, and there is huge demand from the industry perspective. And if you look at non-developer, it could be composite loans, it could be self-construction or a resale. I think demand is across. In terms of geographies, across there is demand. There is not even one single geography which I can point out and say that the market is not revived. In terms of profile, there is huge demand for salaried. However, for self-employed non-professional, that could be because of COVID, I think the demand is low. At least for us, we are seeing low in demand. But there is a huge demand in salary. I think that has really offset low demand in self-employed. I think overall, for next 3 to 4 years, housing finance companies will definitely do well. Rates being the lowest, at least at this point in time, maybe next quarter or 2 quarters, rates might start inching up, but it will not be drastic. I think for next 4 to 6 quarters, rate will not go too much, maybe maximum 100 to 125 bips. And that is something which we can very easily manage. And for housing finance companies and NBFCs, if the rate goes up, definitely, I think from a company perspective, from an industry perspective, it is going to do good for their numbers. May not be true for the customers because customers have to pay more EMIs and stuff like that. But I think overall, real estate will do well for next 5 to 6 years. Housing as an industry will do well for next 5 to 6 years. So I think as of now, everything looks to be very, very good. Even on the collection front, efficiencies have improved. It is better than pre-COVID levels. In spite of moratorium, in spite of restructuring, I think collections are better. I'm talking about only housing, not about other products in the NBFC. Housing is doing very well.
Sure. But when it comes to loan disbursements, are you still cautious?
We are not cautious at all. Only thing is the demand from self-employed non-professionals, that is little low. It is less compared to even pre-COVID levels. At a portfolio level, we were at 70% salaried and 30% self-employed few quarters back. Now, if you see incrementally, I think self-employed non-professional has come down to about 20% and salaried about 80%. So incrementally, we are seeing less demand from self-employed. We are not cautious. I think self-employed as a segment, I think they're really shying away at this point in time. Probably it will take few more quarters for them to come back. That really could be COVID impact. Otherwise, we have not relaxed or tightened any of the credit or policy norms because of COVID. When COVID was there, we had tightened the process, not the policy. And in Q3 of last year, we again restored all the tightenings what we had done. After that, there has been no change. And we as a company, we are not cautious. We are, of course, we are prudent in terms of underwriting, and we are pretty aggressive in terms of growth. I think that's where we stand.
Right. So can you talk about margins? Because top brokerages are expecting that strong growth is definitely coming for Can Fin Home, but with a little bit of disadvantage that one saw with rapid fall in margin. Can you explain that?
Yeah, in fact, if you look at last year, because of COVID, economic activity was down, and therefore it necessitated all the banks to really focus on products, which could easily scale up their book or at least retain their overall book. Corporate was not doing well, SME was not taking off, and only retail was doing well to a certain extent. Within consumer, within retail, mortgage as a space, was doing pretty okay, and within mortgage BT. So last year we saw flight of book from NBFCs to banks because all the banks, both PSU and private, they were focusing on balance transfers because that was easy kill, because demand was not there, and therefore existing customers, switch was an easy option for banks. And all the HFCs lost out because of their higher yield on book, and therefore we changed our pricing strategy. If you look at the same time, I think last year our yields were about 9.07, and today it's about 7.73 incrementally. On book, it's about 8.06. Right? So there is 100 bips difference in the yield itself. So we changed our pricing policy. We dropped rates so that we can retain our existing customers and also try and do some business which was available in the market. Now, that was the story which was there till Q4. From Q1 onwards, if you see, there is a reversal in the trend. Our margins came down till Q4, both NIM and spread. But if you look at Q1 and Q2, there is a reversal in the trend. And now you will see every quarter our spread will improve, margins will improve. On an absolute basis, because there is change in the yield, both revenue and PAT, there could be either flattish or there could be slight degrowth. But I think this will get corrected in next 2 quarters. By Q4 end, I think we'll be able to show a little bit of growth even on revenue and PAT vis-a-vis compared to last year. So I think because it's going to be a lag effect, whatever action we took last year, it showed up 2-3 quarters after that. Now in last 9 months, we have increased rates twice. So the entire yield on the book has increased. So this impact you will see in Q4 onwards.
Right. So in terms of asset quality, because prices are going up, inflation is on the higher side, most of the SMEs are doing well. You just get a sense that asset quality pressures may not be there even if strong growth comes in.
See, I think there are two ways to look at asset quality. So one is genuinely where the book is very strong, portfolio is pristine. I think you will not see any challenge on the asset quality because moratorium didn't really have much of impact on the book. I think the second question could be on restructuring, which will play out probably in next 4 to 6 quarters. If you look at NBFCs, I don't think so there'll be too much of stress on asset quality. That's for the simple reason all the stress customers, they would have opted for restructuring, and therefore there is enough breathing time for customers to improve their business, come back and start repaying. And therefore I don't see there'll be any, maybe it could be structural, but I don't think so there'll be any challenge because of restructuring. No stress on asset quality could be seen at least in next 3 to 4 quarters time.
Sure. Interesting. Girish, as we look forward, given that in our last interaction you had also said that you are witnessing broad-based demand across segments and geographies as well, what is the current scenario? Is it still pretty much a broad-based growth, or are you seeing certain geographies contribute more than the others?
No, it is, I think demand is across all segments, all the geographies. The only change which I mentioned is that in terms of profile, there is less demand from self-employed non-professional. Salaried demand is quite huge. I think barring this particular change, I think demand is broad-based.
Okay, great. Great to have you on the show, and here's wishing you and your entire team a very happy new year from all of us.
Thank you. Wish a happy new year to you all.